Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. Market Update. Boy, what a difference a week makes in the U.S. markets. We take a look at the chart. You can see that we had this big, huge move to the upside on Friday that had a lot to do with the jobs report. We'll talk about that here in a second. But first, let's take a look at this triangle that we were talking about in last week's report. And you can see that we have had a breakout. Now, the rules of these triangle breakouts, and remember, a triangle is one of the Elliott corrective patterns. I know I keep talking about this, but when we say it over and over and over again, then it becomes second nature to you, and it's not anything new that you haven't heard before. But you need two consecutive moves for a confirmed breakout. So there's no question that we broke out of the triangle on Friday, but Monday is going to be key. So again, for the rules of a confirmed breakout, meaning that you expect that directional breakout to continue, you need two consecutive, in this case would be higher closes. If it was a downside breakout, you would need two consecutive lower closes, with the second day being a follow-through or confirmation day. So we built this really nice triangle and we exploded to the upside. We had talked last week about this downward move that we had, and really right down to that lower trend line and then the recovery. So the negative news that was coming out of the market wasn't able to continue to push the market down to the new low. We had the fears of the tariffs that were announced by the Trump administration. We had Gary Cohn resigning, who was very well thought of on Wall Street and thought to have been a major economic contributor to Trump's plan. So that was feared would be a big, huge negative to the market, but nothing kept the market from recovering back to the upside from the downward move of last week and then the big breakout that occurred today. So I want to go through what occurred on Friday with the jobs report in general terms and go through the charts, and then we'll come back and give you a little bit more detail, just so that I'm not talking about all the economic stuff for too long in a row to bore you. But it was an awesome jobs report, unlike what we've had for the last number of years. According to the government's report, and we also have a private report we'll cover as well, 806,000 jobs were added to the workforce in the month of February. That's the most since the Reagan administration here in the U.S., and that was from a plan. Some call it Reaganomics, but the Reagan administration actually put into play this thing called the Emergency Economic Recovery Act. And what they did was they rolled back regulations, they cut taxes, they created tax incentives for companies to invest, whether it was in their own company or technology. And the GDP surged during that time. It was a time of great growth and abundance in the U.S. We had a month where over 1 million jobs were added, and maybe this is starting to sound a little familiar because this is basically exactly what the Trump administration has been doing with cutting taxes, rolling back regulations, etc. And we're seeing this not just in the markets, but in the economy as well. So we had about 8 years of really a no-growth zone here in the U.S. based on the previous administration's policies, which weren't geared towards growth. And there was really no incentive for people to go out and find work, and the economy suffered. We didn't have one single year of 3% GDP under the previous administration, and you probably have heard me. If not, you will hear me talk about this from an economic standpoint. In the U.S., you have to have at least a 3% GDP to have real growth. So you're saying, well, we were dealing with 1.5%, that was it. Well, why isn't that growth? Well, you need 3% in order to offset the normal inflationary pressures, things like that. So we need a GDP of 3% to offset the things that occur normally in an economy in order to get us to real growth. And the expectations are obviously being built into the market that we will indeed do that. So as I said, we'll break down the jobs report a little bit more towards the end, but let's go ahead and look at some charts. Where are we going to go from here? Well, another thing that's important to look at is that downward zigzag that we talked about. Remember the rules. You have to touch the previous fib level. So even with this move back up on Friday, and by the way, the news about Trump meeting with North Korea certainly added to the fuel of the rally on Friday. We were already in a nice rally when that news came out, and that just, all the bears just packed up and said, bulls can have it. We're out of here for today. So basically all we did was come back and recover this this downward move from the beginning of last week. So these 2 weeks even out, and we're back to square one. However, we have not touched the 78.6% fib retracement level yet. So from a technical standpoint, again, just following Elliott rules, we have not disqualified the potential for a C wave lower. Obviously, at this point in time, it looks a little bit less likely, but from the pure technicals, it's not been nullified yet, or using correct terminology, disqualified yet. We're pretty close, but we're not there yet. So that possibility still exists. And again, remember, if we do go up and hit this 78.6% level, then the likelihood is that we go up and retest those highs, and then we'll see what happens from there, and the pattern start over again. Again, we'll be looking at Monday's move for a follow-through day or the confirmation day from the triangular breakout, and looking at the SPY. Note that we did finally have some lower volume in the consolidation. We had noted that usually when you consolidate, the volume drops off. It hadn't done that, but it did do that during this past week. And then we have the above average volume surge, as you can see here, on the move Friday. So there was not just short covering, but legitimate buying in the market on Friday as we move to the upside. So there's the same triangle on the SPY. Now remember, we talked about the VIX and how 15 that had been resistance for so long was now going to be support. And look where we are, where we closed on Friday. So we broke below that 15 level and then closed right back, right at it on the close. And this will be key. If we bounce off of this, if this does become support and we bounce off of it, then that again lends credence to potential move lower in the market, and perhaps that C wave still continuing. Obviously at this point, I just want to go back here, it would be a complex C wave where we had the mono wave A, mono wave B. Stands to reason that we're going to have a complex C, but let's let it all play out, and we'll examine that in next week's report. So again, we're right here at the support level of the VIX with that new 15. If we break below that and close below that and get the 2 consecutive closes, because it's the same rule when you're breaking a major support or resistance line, then we could possibly drift back down to that 10 level. I've felt that that's less likely, but it's still a possibility. Nothing's 100%, and I'm certainly not right 100% of the time. So we'll see how the market plays out. Did want to show you the dollar chart. Again, just consolidating right in this area, you know, without me bringing it up again. We're right in that 161.8% fib extension. Interesting. I think that with that great jobs report, that interest rates didn't move up significantly and didn't cause the dollar to move up significantly. However, a likely reason for that, which I'll get to when I break down the jobs report numbers, is wages. Even with as strong as the jobs report was, the wages were actually went up less than expectations, and so that's not an inflationary sign, and that could have kept the dollar floundering down here and interest rates not going higher. Here's TNX, the chart we've been looking at, and you can see we're still in this. We talked about this little small triangle that we have right here, and just really hard to even call that a breakout. We had a breakout attempt, but then the closing price there, that little notch to the right in that bar, is really right at around the point. So you can call that a breakout attempt, but not a breakout. And then remember, from the upward target that we have here on this zigzag, the extended target is still a little ways away up there at 161.8%. An upward breakout from this triangle would pretty much put us there based on triangular breakout rules. Last but not least, we brought this chart in last week, Paycom, and look what happened. It continued to the upside in the C wave of the zigzag. This is why we like showing you these patterns. The zigzag pattern, in my opinion, is more reliable. Not just my opinion, it was in Elliott's opinion as well. Even have a higher percentage of occurring and happening than the 5-wave directional trending patterns that everybody is so used to. If you remember last week's report, we started right here with this doji coming out of the support level there at 75. We talked about how we had a complex A wave, so I don't need to go through that again, I don't think. So let's just take a look and see where we are. Here was our fib retracement, noting that we went to the 61.8% level and using that as the point here, and you can see that we are awfully close to hitting that 161.8% extension level. We've got a doji there. We are right there. We had a high of 110.25, and you can see the 161, and obviously this is not an exact science when we're talking about a few cents here, a few pennies. I know that some of our slang with our money is not common to those of you down under, but after the decimal point, a few cents left, you could move around the extensions and the retracements slightly and easily draw this to where we're hitting it exactly. But we did break above that last week, and we surged right up to that extended level, so we did have the extended C wave, and I showed you this last week, so you know this isn't me coming back and saying, hey, look, we broke the 100% level, that's why we went here. We showed it to you last week before it happened, and so it followed through and did exactly what it was supposed to do. So that's quite interesting that it worked, but not surprising, because that's how impressive these zigzag patterns are, and look forward to educating more on these as we continue forward with this Elliott Elite education and these updates. So let's before we finish, let's I'm going to go back to the VIX and show you this chart, because we're going to get into sentiment, and then we'll look at the jobs report a little deeper. I know it's not probably as important to those outside of the U.S., but it is interesting here. The government's report for non-farm payrolls added 313,000. We only had 210 expected, so it was much higher than what had been expected. The government's unemployment rate, I still don't like this number. I don't even like to report it, because it doesn't count those that have been unemployed so long that they no longer get benefits, but regardless, it's moving low. The unemployment rate went from 4.1 down to 4%, and for our minority unemployment here in the U.S., both black and Hispanic unemployment are at record lows. So it's broad-based with the jobs report. It's not just select races or ethnic groups, etc. The household survey, this is the private one that I mentioned, said that 729,000 full-time jobs were added in February, another 277,000 part-time jobs with the regulation rollback, and now we don't have that regulation for health care, the Affordable Health Care Act, that was stopping people from hiring, like stopping companies from hiring employees for more than 30 hours a week because they didn't want to have to pay the health care benefits. Now that that kind of stuff is being rolled back, you're starting to see the work week move up, and the work week did go up from 34.4 hours a week to 34.5. So average work week creeping up. That's a good sign. When you have that, by the way, the number was 34.3 in January, so 0.2 of a point increase from January, so that's a bit more significant. It was just a 1.10 expectation. But here's the thing, the wages only rose by 0.1% when 0.2 were expected, and that was what a lot of people, a lot of the financial networks were talking about as far as the best news out of the job report, is that we're adding all these jobs, but there's not wage pressure on companies, so it's not inflationary, so we're adding jobs without significant. I mean, some inflation is there. It's just hidden. But we've talked about this where companies are selling products for the same amount of money but in smaller portions. So they've decreased the size of the portion but still selling it for the same amount. That's not really tracked in inflationary data. Only the pricing is tracked with our PPI and CPI. Our participation rate, which has been a point that I've brought out for a long period of time, showing that there was a significant number of working age, able-bodied Americans that didn't have jobs, finally went up, and it went up a lot. It went up to 63, which is a 0.3% increase month over month. That is a lot. That's a lot of people. And according to the private sector, we added 1,006,000 new jobs in the month of February. Very, very significant. Here's what I think is the most important part of the jobs report, not necessarily agreeing with all the other financial networks, is that we are adding jobs in the higher paying sectors. Through the previous administration, even though, yes, they added jobs, it was always in the lower two sectors from a pay standpoint. So you could get a job, but it wasn't a high-paying job. But we added 61,000 construction jobs. We added 31,000 manufacturing jobs. We've added 224,000 manufacturing jobs over the past 12 months, 263,000 of those since the election. So showing that since the election has not only added all the jobs, but recovered some of the manufacturing jobs that had been lost earlier in the year before the election. So that's the most important thing, again, in my opinion, is that these are quality jobs that are being added, not just part-time jobs, because we had a long period of time where people were just getting 2 part-time jobs in order to survive because they couldn't get a good full-time job, again, due to that Obamacare, the Affordable Health Care Act, etc. Last but not least, I'm showing you the chart of the VIX. We talked about the 15 level in the Investors Intelligence Survey. The bulls actually climbed back up just a little bit to 48.6, but that's not in the area of too many to the upside or too many bulls. It's not in a worrisome level for those of you that want to see the market go back to the upside. And we finally did get a little bit of an increase in the bears from 14.4 previous week up to 15.5 this week. So a slight increase, still very, very low on those that are bearish, but a little bit of an uptick. And based on this past week, in this weekend's report, that may go back down in next week, but we'll have to wait and see. But we're in a little bit of a sweet spot there as far as we don't have too many people that are too bullish to the point where there's nobody left to be bullish. So the market does have some room to go to the upside if it wants. So we're at some key levels here. We want to see if we hit the 78.6% and disqualify the zigzag, or do we reverse back down? And that was a one-time aberration on an ultra-strong jobs report, and things change with the viewpoint next week. Worrying about, maybe there'll be more Fed rate hike increases, etc. We'll just have to see how all that plays out. And then, of course, the fact that the VIX is sitting right on a support level. So hope you've enjoyed a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.